So I know firsthand that options can be very confusing when first learning about them. So in this video, I'm going to teach you what options are and how to think about them so that they make sense to you on a deeper level. Now, the first concept that you need to understand before we move on to the more specific details is that options are traded against specific stocks. So when we talk about options, we have to talk about the options of a specific stock. So for instance, Apple and Tesla both have their own options that traders use to try and profit from the future stock price movements in those specific stocks. Now, unlike stocks, which are just shares of stock that are bought and sold, options have unique characteristics that we need to talk about before we get into the rest of this video, otherwise nothing's going to make any sense. So first and foremost, every option has an expiration date, which is the date that the option's final value is determined and the option can no longer be traded. Now, most stocks will have options that are expiring anywhere from a few days away to up to 2 years away. Now, the next unique characteristic of options is called a strike price, which is the price at which shares will be bought or sold if the option buyer exercises that option. Now, I know this is confusing, but stay with me because everything is going to make complete sense in a couple minutes. Now, the last characteristic that we need to talk about is called an option contract multiplier, which in the simplest terms is the number of shares that the option contract can be converted into if that option is exercised. Now, for the most part, most options will have an option contract multiplier of 100, which means that the option can be converted into 100 shares of stock if it is exercised. Now, at this point, you're probably wondering, if options are so complicated, then why do people trade them, and what's the benefit of trading options instead of just shares of stock? Now, probably the biggest appeal of trading options is that they can leverage your returns relative to a simple stock trade. So let's go ahead and compare a hypothetical stock trade and an option trade to illustrate this point. So let's say we buy 4 shares of a stock for $150 a share and sell them 30 days later for $160 a share. Now, of course, this is hypothetical, but the profit on that trade would be $40 since we bought 4 shares of stock and they increased by $10 per share. Now, a $40 profit on a $600 investment is a 6.7% return. So let's compare that to a hypothetical option trade. So let's say we bought the 30-day 150 call option for $5, and with the stock price at $160 30 days later, we sold that call option for $10. Now, the profit on that trade would be $500 because the option price increased $5 from where we purchased it. Now, remember, a standard option contract has a contract multiplier of 100, so that $5 increase in the option price actually represents a $500 profit. Now, since we paid $500 for that option and we sold it for $1,000, our return is 100%. So clearly, you can see that by trading an option, you can leverage your returns immensely relative to just a simple stock trade. Now, unfortunately, it's not all good news when trading options, because if the stock price had stayed right at $150 over that 30-day period, then the trader would have lost the entire $500 investment in that option. So now that you've seen the power of options and why they can be so appealing, we need to get you up to speed on the essential concepts that you need to understand before actually starting to trade options. Now, stay with me because we're going to go in depth and explain both of the option types. So the first option type is a call option. Now, a call option gives buyers the right to buy 100 shares of stock per contract at the option strike price before the option expires. So let's go ahead and look at some examples of call options and strike prices. So if a call option has a strike price of 100, that means that the call buyer has the right to buy 100 shares of stock for $100 a share before the call expires. At $110 being the strike price, the call buyer has the right to buy 100 shares of stock for $110 a share before the option expires. And at $120, the call buyer has the right to buy 100 shares of stock for $120 a share before the call expires if they so choose to. Now, logically, it would make sense that buying shares at lower prices would be more favorable to buying shares at higher prices. So why not buy the call option with the lowest strike price? Well, the answer is that calls at lower strike prices cost more money for 2 reasons. The first being that there's more value in the ability to buy shares at lower prices, which is the strike price of the call. And the second reason is that calls at lower strike prices have a higher probability of being valuable at expiration. So if we go back and look at the option prices at each strike, let's say the stock price is currently at $100 and we look at the call option with the strike price of $100. that option might be worth $3.50, and the call with the strike price of 110 might be worth 63 cents, while the call at the strike price of 120 might be worth 6 cents. So let's go over a more specific call option trade example so you can better understand how the position would work out in certain scenarios. So let's say we have a stock and the price is currently at $50. And let's say a trader's prediction is that the share price will increase to $60 in 2 months. Now the hypothetical option trade would be to buy the 50 call that expires in 60 days, and let's say we buy that call for $5. Now, based on the stock price in 60 days, let's look at the P&L of that position. Now, if the company goes out of business and the stock price is $0 in 60 days, then the P&L of that call option would be a $500 loss. Now, that's because that call option would expire worthless since the stock price is below the call's strike price at expiration. Now, let's say the stock price didn't move at all and it was still at $50 in 60 days. In that case, we would still lose $500 because at $50 per share, that 50 call option does not have any value because the stock price is not above that call's strike price. So again, we would lose $500 if the stock price did not move over that 60-day period. Now, if the stock price increased to $55 and was at $55 at the time of that call's expiration, then we would not have a profit or loss on the trade because the call option would be worth $5. And since we purchased it for $5, there would not be a profit or loss on that position. Now that call option would be worth $5 because with the stock price at $55, that call option has the ability to buy shares $5 below the current stock price, which explains why the call option is worth $5. Now if the stock price were to rise to $60 over that 60-day period, the profit on that call option would be $500 because that call would be worth $10. Now the call would be worth $10 because the strike price is $50 and the stock price is at $60, which means that call option has the ability to buy shares $10 below the current market price, and that explains exactly why the call option is worth $10. Now remember, since that option contract multiplier is 100, the $5 increase in the option price from $5 to $10 equates to a profit of $500 per call contract. And finally, if the stock price were to increase to $65, that 50 call would be worth $15, which would represent a profit of $1,000 per call contract. Now just to hammer home this concept one last time, that 50 call option would be worth $15 with the stock price at $65 because with the stock price at $65, that 50 call option has the ability to buy shares $15 lower than the current market price, which explains why the call option is worth $15 per contract. Now, when we compare buying the call option to buying 100 shares of stock, we can see that when the stock price decreases significantly, the loss on the shares is far more significant than the loss on the call option. However, if the stock price stays the same and does not increase, we'll have some losses on that call option, whereas the stock position won't have any losses at all. Now, when the stock price increases significantly, we can see that the P&L on the stock position is actually a little bit higher than the call option's profitability, but in terms of return on investment, you'll have a far greater percentage return on investment when you look at the call option compared to that stock position. And that's because to buy 100 shares of a $50 stock, you have to put up $5,000, whereas in this example, you only needed $500 to get similar profitability. So that's an example of how buying a call option can work out, but call options can also be sold, which turns the position into a bearish trade. So let's go ahead and look at an example to see what that might look like. So let's say we're looking at a stock that's trading around $100 and we go ahead and sell the call option with a strike price of $110 and we collect $5 for that option. Now if after selling that call option the stock price trades sideways, decreases, or even increases slightly, the position will work out favorably because that call option will expire worthless as long as the stock price is below the strike price of $110 at expiration. However, if the stock price increases significantly, then selling that call option could turn out to be a very dangerous play because there's no limit to how much a stock's price can increase, and therefore there's theoretically unlimited loss potential when selling call options. So let's go ahead and look at the hypothetical profit and loss of this position based on various stock prices at the time of expiration. So if the stock price ended up increasing to $200 per share, which would be a monstrous move, The loss from selling that call would be $8,500 per call contract. Now that's because with the stock price at $200, that 110 call is going to be worth $90 because it has the ability to buy shares of stock $90 below the stock price. And since we sold it for $5, that means we would have a loss of $85 per call contract. And with the option contract multiplier of 100, the loss would be $8,500 per call that was sold. Now, if the stock price was right at $115 per share at expiration, there would be no profit or loss on that call position because since we sold the call option for $5, the call option would be worth $5 if the stock price was at $115 because, as you know, with the stock price at $115, there's $5 of value in being able to buy shares of stock $5 below the current market price. Now, of course, if the stock price is at or below the strike price of $110 at expiration, then that 110 call will not have any value and it will be worth $0 or worthless at expiration. Now, of course, if you sell an option for $5 and it expires worthless, then your profit will be $5 per option contract, which in actual profit terms is $500 because of that $100 contract multiplier that we talked about earlier. So now that we've talked extensively about call options, it's time to get into the second option type, which is a put option. Now, a put option is basically the exact opposite of a call option because a put option gives the buyer the right to sell 100 shares of stock per put contract at the put's strike price before the put expires. So, for example, if we have a put with a strike price of $75, that option holder has the right to sell 100 shares of stock per put for $75 a share before the put expires. Now, if you buy a put with a strike price of $80, you have a right to sell 100 shares of stock per put for $80 a share before the put expires. And if you buy a put with a strike price of $85, you have the right to sell 100 shares of stock per put for $85 a share before the put expires. Now, as you might have guessed, this is exactly the opposite of call options, because put options gain value when the stock price falls, as the ability to sell shares at the put's strike price becomes more and more valuable as the share price decreases. So with put options, as the stock price decreases, the put option's value will increase. So to illustrate why this makes sense, let's go ahead and look at an example. So let's say we have a put option with a strike price of $85. If the stock price is at $80, the 85 put will be worth at least $5 because the ability to sell shares $5 above the current market price is worth $5 per share. However, if the stock price decreases from $80 to, let's say, $70, then that 85 put will be worth at least $15 because the ability to sell shares of stock $15 higher than the current market price is worth $15 per share at a minimum. So as we did with call options, let's go through a trade example, and this time we'll use put options. So let's say the stock price is currently at $200, and let's say the trader's prediction is that the stock price is going to fall to $190 per share sometime over the next 30 days. So the trade we're going to look at is buying the 200 put that expires in 30 days, and we're paying $6.50 for that put. So based on this trade, let's go and look at the P&L of the put position based on various stock prices 30 days later. So in the first scenario, let's say the stock price increases to $250 in 30 days, quite opposite of the trader's prediction. In this scenario, the put P&L would be a loss of $650 per put contract because that put option would expire worthless, and since it was purchased for $6.50, the loss on that option contract is $6.50 times that $100 contract multiplier, which comes out to a loss of $650. Now remember, that put is worthless because with the stock price at $250, there's no value in being able to sell shares at $200. Now if the stock price stayed the same and was right at $200 30 days later, we would also lose $650 because there's no value in using that put option to sell shares of stock for $200 a share since the share price is already at $200 a share. So in that case, there's no value in the option and therefore it will expire worthless. Now, if the stock price decreased by $5 to $195 per share over that 30-day period, then the put option with a strike price of $200 would be worth $5. Now, that's because with the stock price at $195, we have $5 of value being able to sell shares of stock $5 above the current market price. But since we purchased the put for $6.50 and at expiration it was only worth $5, we would lose $150 per put contract. Now, if the stock price decreases to $190, then we would have a profit of $350 per put contract, since that 200 put is going to be worth $10 and we purchased it for $6.50. Now, that put contract is going to be worth $10 because with the stock price at $190, there's $10 of value in being able to sell shares of stock $10 higher than the current stock price, which explains the put's value of $10. And lastly, if the stock price fell dramatically to $175 per share, that put would be worth $25 because there's $25 of value in being able to sell shares at $200 when the stock price is at $175. And with the put contract being worth $25, we would have a profit of $1,850 per put contract since we purchased it for $6.50 and it increased to $25. Now, just like call options, put options can also be sold, and that turns the trade into a bullish position. So let's go ahead and look at an example just to illustrate how that would work. So let's look at a stock that is currently trading at $190, and instead of buying a put, we actually sell the 170 put, and we collect $7 for selling that put. Now, it doesn't matter if the stock price trades sideways, increases, or even decreases slightly. At expiration, if the stock price is above that strike price of $170, that 170 put is going to expire worthless, in which case we will make $700. Now, with that being said, selling a put option is a highly risky strategy. Let's say the stock price decreased to $150. If the stock price is at $150 at expiration, that 170 put is going to be worth $20. Now, since we sold it for $7 and it rises to $20, the loss would be $1,300 per put contract. Now, we've covered a ton of content in this video, so let's go ahead and recap what we've learned so far. So let's start with call options. Now, when you buy a call option, that gives you the right to buy 100 shares per call at the strike price on or before the call's expiration date. Now, as a call buyer, you want the stock price to increase as much as possible above the call's strike price, as the call's ability to buy shares at a discount to the current share price will become more and more valuable as the stock price increases. Now, if you sell a call option, that actually gives you the obligation to sell 100 shares of stock per call contract at the strike price if a call buyer exercises and you are assigned. Now, I know we didn't talk about that in this video, but we did a full playlist on options trading basics, and one of those videos is on exercise and assignment, which dives deep into exercise and assignment and teaches you everything you need to know about those two concepts. Now, I highly suggest you click on that playlist link that is in the description, as it'll cover the most important concepts you need to know as an options trading beginner. All right, now moving on. Now, as a call seller, you want the stock price to remain below the call's strike price as time passes, as the option will expire worthless if the stock price is below the call's strike price at expiration. And as we've seen, that means you will keep 100% of the premium that you collected for selling that call option. So moving on to put options. When you buy a put option, that gives you the right to sell 100 shares of stock per put at the strike price on or before the put's expiration date. Now, as a put buyer, you want the stock price to decrease as much as possible below the put strike price, as the put's ability to sell shares at a premium to the current share price will become more and more valuable. So the further that stock price sinks below that put strike price, the more valuable that put option will be, which as a put buyer means that you'll generate more and more profits as that stock price decreases. Now, as a put seller, you actually have the obligation to buy 100 shares of stock per put at the strike price if a put buyer exercises and you are assigned. Now, lastly, as a put seller, you want the stock price to remain above the put strike price as time passes, as the option will expire worthless if that stock price is above the put strike price at expiration. And if that's the case, then you will keep 100% of the option premium collected for selling that put option.